Right, okay, so in this video I'm going to be talking about the two tools that the government is using in order to manipulate the economy. It's either it's going to be stimulating a very sluggish economy, or it's going to be slowing down an economy that's moving way too fast. So we have two tools, namely the monetary policy, excuse my money now, sorry about my writing, it's not the best in the world, but at least you can understand it. The monetary policy and the fiscal policy. But we're only going to be focusing on the monetary policy in this video. So, basically monetary policy is just deciding on whether to print more money or print less money. It's the Federal Reserve of the United States, or in our case in the Philippines, it's the Bangko Sentral ng Pilipinas, that is deciding whether it's going to be printing or supplying more money or printing less money. So, or printing money. Okay, so under the monetary policy, we first have the easy or the expansionary monetary policy. I don't know how to spell words, I'm sorry. The expansionary monetary policy. And basically what this does, it increases the supply of money which is to be lent to the market. And I'm going to be showing that in a diagram right now. So say this is the market for money. And on the y-axis we have our price for money, which is really just the interest rate. And on the x-axis we have our supply for money, and then we have our demand for goods and services, and we have our supply curve. We have our supply curve, supply of money. And now you see here we have a clearing interest rate or an equilibrium price for money, which is at, say for example, it's at 6%. That is our current interest rate. And let's analyze. Say for example, the Bangko Sentral ng Pilipinas decided it's going to be supplying more money, which would look like this. This is our new supply of money. And you see what happens. Suppose that the demand did not change. What you see happening here is we now have a new clearing interest rate that is a lot lower than before. Say for example, this is now at 3%. So what happened is that when the government is increasing the supply of money, it then why does it keep on doing that? When the government is increasing more money, it then drags down the interest rate, which then encourages the people to borrow more money. And in practical application, say for example, I borrowed money from the bank. Of course, it won't make sense for me to borrow money if I'm not going to be spending it. Pretty sure I'm going to be buying goods and availing services of some sort. So that would mean an increase in, sorry, why does that keep on happening? That is going to be increasing the demand for goods and services. And if we look at the I'm just going to be using a new note. This is how it affects the AS or AD model. Overall price level for goods and services on the y-axis, and on the x-axis we have our real GDP. Upward slope on the aggregate supply, and a downward slope, and and a downward slope on the aggregate demand. We have an equilibrium level at this point. So now we have an ASAD model that's going to look like this, because the aggregate demand is now increased. So what we see here is we have a new equilibrium level, which is a lot higher than the previous one. And see, all of the change that we have here only shows that the economy is actually growing. So yeah, that is what expansionary monetary policy does. Really, it took me this long.